On October 8 this year, the Chinese State Administrator for Market Regulation imposed a 3.4 billion RMB fine on Meituan, a penalty for abusing its dominant market share in the food delivery business to force restaurants into exclusive arrangement. Sound familiar? This is comparable to the violation that is levied against Alibaba, which was fined 18 billion RMB in April for breaking the country's anti-monopoly law as well. Yet, Meituan's stock price actually rallied 17% since the news. Is this the signal of the bottom of the Chinese tech stock, and is Meituan now a good stock to look into? Let's find out in this video. Hi guys, Stanley here. I'm the co-founder of ValueInvestAsia.com, an investment portal where we'll give you investment news and also in-depth analysis of listed company every single week. So if you're new to the channel, remember to hit that subscribe button so you'll not miss out on any of our videos. Investors really hate uncertainty, and when uncertainty is high, they tend to sell off a stock ahead of any concrete resolution to the problem. So when the real bad news hit, sometimes stock can rise despite the unfortunate headline because now the uncertainty is gone. At least that might appear to be the case for Meituan stock right now. And to put things into perspective, the penalty amount to just 3% of Meituan's 2020 revenue. And other changes that Meituan would need to do will include things such as improving its commission mechanism and ensuring the legal rights of their restaurant partners and also the protection for their delivery riders are improved. Although the share price has rebounded significantly over the past few weeks, it is still down significantly for this year. And with the trouble settled, Meituan now could be an interesting company as China emerged from the pandemic. It is perhaps one of the best proxy to gauge the vibrancy of the renewed consumer spending in China. The company organized its business into three main segments: food delivery, in-store hotel and travel, and new initiative and others. So let us look at each of these segments individually. Number 1, food delivery. Food delivery is Meituan's largest revenue contributor. While many US food delivery companies have struggled to make money, Meituan's food delivery segment is actually quite profitable and command about 2/3 of the market share in China. In Q2 this year, Meituan food delivery business has generated more than 3.5 million meals delivered, generating a revenue of 23 billion RMB, which is up about 60% year-on-year. Meanwhile, its operating profit grew 95% year-on-year to 2.5 billion RMB. That means that it has an operating margin of more than 10%, which is pretty impressive. Next is Meituan in-store hotel and travel business. This has rebounded very strongly since the reopening of the economy from the pandemic. In the last quarter, its revenue grew 89% to 8.6 billion RMB, and its operating profit was up 94% to 3.7 billion RMB. As a group, Meituan derived the majority of its profit from this segment, and this is due to the high 40% operating margin that Meituan enjoys. Meituan has a strategy to acquire users through high-frequency services such as food delivery and then cross-selling them to higher margin services like travel and other services. So both of these core businesses have reached a very profitable stage. That said, Meituan did not make an operating profit in the last quarter at all. Instead, it recorded an operating loss of 3.2 billion RMB as a group. This is because it is plowing back most of its profit into its new initiative segment as it seeks to expand very aggressively into key segments to compete with other large Chinese e-commerce companies. So Meituan new initiative segment comprised with a few services. That includes group buying, instant shopping, grocery, and even ride-hailing. Revenue from this segment grew more than doubled to 12 billion RMB, but the operating losses ballooned to 9.2 billion RMB. Firstly, there is Meituan Select, the company community e-commerce group buying business. Group buying is where a community or group of members team up to buy in bulk for more discount. This mode of purchasing is very popular in China, but competition in the group buying space is also fierce, as the company has to fend off equally well-resourced rivals like Alibaba, JD.com, and of course, Pinduoduo. Secondly, there is Meituan Instant Shopping and Grocery, which offers a on-demand delivery of fast-moving consumer goods or even fresh grocery. Both services leverage on Meituan's delivery riders to expand their range of e-commerce services. And finally, there is Meituan Dache, the ride-hailing aspect of the business. China is now the largest ride-hailing market in the world. The country accounts for about 13% of the global ride-hailing consumption, with a market size of about 5.7 trillion renminbi. And that figure is expected to grow at 13% a year to reach around 10 trillion renminbi by 2025. So while Didi dominates this market, Meituan's more than 6 million user base could potentially give it an easy way to cross-sell up to these services, making it a very strong competitor. So Meituan is a cash-rich company with a market cap of around 1.7 trillion Hong Kong dollars. Yet even after the recent rally, the stock is still down nearly 30% from its highs. So if you're interested to invest more into Chinese tech company, Meituan is definitely one to consider as well. However, investing in China can be quite different from investing in anywhere else due to the unpredictable regulational risk. So there's also something to keep in mind. Okay, so what do you guys think of Meituan? Do comment down below and let us know. And if you have gotten value from this video, please give us a like and share it with a friend who you might think might benefit from it as well. If you're ready to take the next step into investing, you can also check out our free investing course at valueinvestasia.com/free course. There we'll teach you practical things like how to read a financial statement to even how to value a stock. Anyway, that's it from me. My name is Stanley. Till we meet again, invest safely.